when you've got money in redraw on an investment loan, that is not a tax deduction. So money in an offset account, because it's separated from the home loan itself, allows you to have the money separated from the home loan. Therefore, the full loan amount is tax deductible. But if you have the money within the home loan amount, that reduces the amount that's tax deductible.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor.
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Hello and welcome back. We've got Maddie Walton again with us from Money Lounge. She's a very cool and very fun mortgage broker. Today we're going to be talking about offset versus redraw and also fixed versus variable interest rates when you are buying a property or thinking about buying a property. But first, money wins, money losses. Who wants to go first?
You're both looking at me, so I feel like it's me again. Okay, I'm gonna have a money loss. I've come down to Melbourne and I always forget that you guys have marquees for public transport. And I have about 6 different marquee cards at home because they're $6 to buy.
They're so annoying.
Every time. And I keep forgetting. And so I have to keep having to buy them because I'm so worried about the inspectors. And so I want to do the right thing and be a good citizen, abiding citizen, law-abiding citizen.
It is such a backwards system.
So I bought another one and I have to put money on there. So that's annoying because I have so many at home. I always forget.
Yep. This is my ultimate thing I hate about Melbourne is marquees because I'm the same. I always forget it. I won't be able to find it because it's deep in my handbag and then I'll get home and find 5 of them.
Yeah.
Or the train's coming, you have to stop and touch on and top it up properly. That's annoying.
Yeah, no, I agree.
I think
Not for me.
The cards are going, I think they had a fixed contract with the government until 2025 or 2026. So they should be phased out and using Apple Pay in the next couple of years.
I think you can have an Android.
Yeah, you can. Just not Apple Pay.
No.
Yeah, because they have a contract or something. So it will be gone soon and there'll be a lot less fees of paying for a card. They should be free.
I don't know if I shared this on a past episode, but I found a card in my house with $50 on it. I was so stoked.
It's like winning the lottery.
I don't think so. Yeah.
No? Okay. Yeah. I was so stoked. I was like, oh my gosh. So
I've won.
I've won the lottery, $50 on a Mikey. That's unheard of.
That's a win.
Yeah.
I'd be stoked at that.
Yeah.
What's yours? Is that yours?
Yeah, sure. That's mine.
Thank you.
I thought I talked about this. Maybe I thought about it.
I don't remember. Maybe.
Yeah. Okay.
Yeah. A bit more of a niche one. I did sponsor content for Annet recently.
That was fun.
Yeah.
Love Annets.
And they kind of let me do whatever I wanted on my stories. I didn't have to take a photo of the shapes box or anything. I could just kind of list them with a fun photo. And I had so many fun, positive messages about it, which is really nice. 'Cause sometimes doing ads can be a bit negative on social media, but everyone loved the Annets ad. They were like, this is so random and so great.
I love that partnership.
Yeah.
I think it's an Australian thing that everybody loves. We're we will always get behind shapes.
Yeah. And because it was a Black Friday sale. So it was here, you can save money on shapes or jats or whatever the crosscuts and stuff as well. So that was nice. Money win.
Awesome. Plus you're all set now for platters and
yes, I did buy a lot for the reel. So I had 9 boxes of things. So we've got shapes
I'd go through that in a week.
Yeah.
They're so good. Shapes are dangerous for me.
Yes. CEO buying shapes for work. Win.
Yeah.
Okay. So let's start with fixed versus variable. Firstly, what actually are they? What's the difference?
So fixed is where in Australia we can have 1 to 5 year fixed terms, 1, 2, 3, 4, or 5. You can choose where your interest rate is fixed for that period. It does not change. And variable is where that interest rate that you have can fluctuate with whatever the economy essentially is doing, whatever the cash rates and whatever the interest rates are doing with the bank. And the bank can change that at any point in time at their discretion as well, which is where loyalty tax can come in because they just sneak it up on you if you're not watching and you don't have a broker, Anna.
I have a broker, but now my broker will be Maddie in the future.
Where they can keep on top of that for you and make sure that you're always on a good rate. So yeah, that's essentially the main difference between the two.
Which ones do you guys have?
Variable.
What about yours?
Well, I was originally on fixed and I was on fixed for 2 years. And now that I think it over, I'm I don't know why it was 2 years, why it wasn't more, because in Canada, you can have up to 30 years. So for my first property, I had it at 1.89 for the 10 years that I had it.
Amazing.
Yeah, amazing. And then here I had it at, it was also something low. And then that ran out in 2 years.
Yeah.
So now I'm on variable.
Did you pick 2 because it was the lowest option?
I don't remember. I think that was offered by the broker. And now I'm wondering if it was like, do they sometimes have like, you can only do 2, or is it something I could have negotiated? Maddie, I know I'll talk to you next time. Maddie's making horrible
it's
faces.
not that. I just find this very common with brokers is they'll fix you at 2 years because that's when our clawback period ends.
Oh,
Yeah.
So they don't need to leave.
So
a lot of
what's a
clients.
clawback for people who don't know?
The way a broker gets paid, this is fun. This is a bit of a sidetrack, but I love this conversation because I think it should be transparent and you should really know how they get paid. So we get paid on commissions. Now we get paid commissions in the bank. Now we get paid approximately 0.65% of your loan size. So at the time of drawdown, aka settlement. And we get paid net of offset, which is really important because if we didn't, we'd be like, oh, get a bigger loan and just put some money in
What's
offset.
net of offset? Minus
You
the
have
offset.
a $500,000 loan, $100,000 in offset. Minus that, that's how much you end up being charged in interest. That's what an offset account is for, to charge you less in interest. So we only get, you only pay interest on the $400,000 instead of the $500,000. We only get paid on the $400,000 versus the $500,000.
So is that
Very
something
important
that like
as
if
well.
a customer disclaims to a broker being like, oh, I'm buying a property, but I'm going to put a lot in the offset, would they strategically
It wouldn't matter.
Okay.
It used to before the Royal Commission, but it wouldn't matter now because if you have a $500,000 loan because you put $300,000 into the property, or $200,000, if you buy an $800,000 property with a $500,000 loan and you've got $100,000 in offset, I'll get paid on $400,000. If you put $400,000 in and you have a $400,000 loan, I'm going to get paid on $400,000. It's not going to matter.
Okay,
That's
gotcha,
the point.
gotcha.
So it's like if you took out equity, I wouldn't get paid on that because you're going to have all that money sitting in the offset against the equity release. So it's just to make sure people aren't taking out more loans than they need because a broker is being dodgy.
So you're saying the brokers will sometimes encourage fixed loans that you don't leave too early.
Sometimes I've seen it and I've had to break fixed loans a lot for some clients that just don't make sense. So again, back to what I was talking about, so how we get paid. So we get paid an upfront commission and a trail commission. So upfront commission of about 0.65% of our loans. So on $500,000, it's about just over $3,000. $3,000. And then every month thereafter that you have the loan, we get paid 0.15% over the year, which 0.15 of 500,000, let's say it's about like $1,200, and divide that by 12 months, that's $100 a month. It's probably a bit less than that. I think it's, that's definitely not right, but around that. So that's how we get a commission. So and it makes sense, again, businesses, banks are businesses. So if within 1 year you sell your house or you refinance or you win the lotto, you pay off your loan, wouldn't we all love that? You haven't paid a lot of interest to the bank in that year and it hasn't made them paying our commission worth it. So therefore we have to pay that full upfront commission back to the bank of $3,000. We should pay it back. And within 2 years, it's about 50%. So as soon as it's over 2 years and 1 day, we keep that full upfront commission. So I've just seen a lot of brokers and
So that's why I got a fixed rate at 2 years?
No, I doubt it. There's probably a lot of reasons. It's just that I've seen some of my clients that I've broken fixed rates on, because when you're on a fixed contract and a fixed rate, you have to pay break fees if you do leave that. Say if you have a fixed rate higher than the variable rate and you want to get out of it, well, they know they're going to lose money on interest for you. So they will charge you. Sometimes I've seen up to $30,000 in break fees.
Yeah, crazy.
Wow, that's a lot.
Because they're losing a lot of money on you as well.
Like during COVID, we kind of knew interest rates were going to go up at some point. So when I was getting mine was fixed for 5 years, but like the 2 year fixed rate was like 1.99 or something. But then the 5 year one was 2.6.
Yes, because they expect that it's eventually going to go up at some point.
I did 5 because I was like, it's going to go up. I think it's
mine
gonna go
was,
up.
I think, that low, like
Yeah.
1.9.
But if you say you wanted to
1.89?
break a fixed rate right now,
Mine's quite expensive to break. Yeah.
it shouldn't be, because you'd be
it's so close. Yeah,
because
initially it was.
But
Yeah.
also it's if the variable rate is at 6% and then the fix is at 2%, they know they're going to get more money out of you paying an interest of 6%. So there may not be a break fee.
Initially, it was quite high because I remember my broker was trying to scare me into not doing it. I had talked to a few different brokers. Mom was like, oh, you're so young. Like, why would you want to fix it for so long? You don't want to be paying this, like, I think it was like $6,000 each year or something the fee would have been. So it would have been like close to that 30,000 initially.
At the start, it would have been high because you're paying a higher fee, a higher rate than when it was variable at 1.99.
Yeah. So remember they were like, don't do that. Like, you're so young, you don't want to do that. But I was like, oh, but it's so cheap for now. And I kind of thought it was going to go up anyway. So that's why I did it. But it is interesting where it's like brokers kind of push you towards like, well, most people do 2 years.
I see it a lot. And so there was a girl that was on a fixed rate of 6.39% for 2 years. And I can get lower than that on variable.
Yeah.
Wow. And so she was on the first home guarantee scheme. So if she got out of that fixed rate, normally she would have had to pay about 10 grand. And so I was like, okay, go to the bank and say you're going to fix it. You're going to get out of it though, because they know that her lenders So she'd have to pay lender's mortgage insurance usually, but her loan to value ratio is 92% on the scheme with that specific bank. And so they ended up putting her interest rate up to 7.1%. So therefore she didn't have to pay a break fee. But the plan was that we were going to refinance the same day straight away, and I could get her at a 5.99% rate.
Okay, so there are ways around it sometimes.
Sometimes there are ways around it, but I've seen that very often. And I'm like, why did you fix at 6.39% when I can get you a lower variable rate? And also just with where the market and the direction of the economy is going at the moment.
But all of that comes down to financial literacy. If you don't know, don't know, right? Like, especially if you're buying a property for the first time, you might not have the support network of other people who can walk you through that.
Yeah.
And I think both of you talked about how looking at buying properties and also people treating you differently because you're younger. I know that was my experience as well. So if you don't have the financial backing, you can easily get stuck in a really, really high interest rate without
just a product that doesn't work for you.
Yeah.
Sometimes, again, interest rate is not everything. I think it's really important to make sure that the product is right for you. And we'll touch on that shortly with, offset, redraw, that kind of thing. But it is important to know that's why education is so important, and why I was disappointed when I was going through the whole process is that I wanted to be educated on why we're going with this product. And so with my clients, this is why we're doing this. This is why this interest rate may look better, but it's not a better product because there might be higher fees, might not be multi-offsets. It depends on the client and how they structure their financial circumstances and their financial system. It's so many things to factor in. But I guess I want to just touch on with commissions and things like that. A lot of people, and there is a misconception with brokers that because a bank is paying them commissions, that has to come from your loan somewhere. And essentially we are just contractors from the bank. They would have, if you went directly to a bank, you would have had to go sit down with someone who's on a salary and is in an office, and they have to pay those overheads and those salaries and those margins that they now don't have to pay because they're just contracting out to brokers, which is why we're having a lot of banks shut down their branches and just less staff because they can minimize their overheads. So what they would have paid someone in an office to write your loan, they're just paying me. So there's no difference to you when it comes to cost, other than that I have way more lenders than just one when you go direct to a bank, and I have a lot more products for you to choose from and narrow down for you on who's best for you.
To clarify, I didn't go through a bank.
I know. Just go through a broker. I think a lot of people just think that they're going to lose out somehow.
And finding a good broker that fits for you, because I've had like some people just also try to belittle me and go find someone who like is working for you.
Yeah. So many choices these days.
There's so many. There's so many people in every industry now. Everything is oversaturated. So it can be hard to find someone that you trust and that you gel with. And I just think that's really important.
Yeah. So with the strategy with like whether you pick fixed or variable, why did you decide to pick variable?
At the time, I didn't think the rates would go up very high.
Yeah, because I hear
I was not in the industry.
The sentiment is like, you should always pick variable because it usually wins out.
The RBA told us they weren't going to increase the rates until 2024. And I trusted that.
Yeah, okay.
Yeah, regrets.
Yeah, what's the general strategy now? Is it like if you think interest rates are going to go up, then you fix, but if you think they're going to go down, you stay with variable?
Well, you can never really pick it.
Yeah.
Obviously, everybody's saying that they may go down next year, and hopefully they do. Obviously, we all need relief. We don't want to go into deflation and start struggling, and people are really, really struggling, and people can't afford the mortgages they have. So it's not really, now I don't look at the outside and what is happening essentially with the outside world. What can you afford? Mm-hmm. What makes sense for you? So some of my clients, they do want to fix because the fixed rates are somewhere around the 5.5% to 6% mark, depending on the length of years. They are lower at the moment than variable, which makes us believe that they believe that the rates are going to go down. But the banks always try and win, right? So if you see an interest rate of 5.8% fixed, 6.2% variable, they think within your fixed term, it's going to be lower than 5.8%. So they're going to be making money off you in the second half of the loan that is fixed. So some people want to do that just because they need the budgeting and they need the certainty. And they're like, yeah, we understand that we're going to be paying more later down the track, but it's all we can afford right now just to keep a roof over our heads. So I do see that a lot, but I really don't write a lot of fixed loans at the moment. It's mainly variable, just with, it has not changed. Interest rates haven't changed in a year. It would be a nightmare if the banks increased it again. Sorry, if the cash rate was lifted again by the RBA, people would riot because everyone's struggling so much already.
Just going back a bit, which I think was a really good point that you said. I just had a flashback because this is like 10 years ago that I bought my first property, but budgeting was a big one. So one of the reasons why I fixed was I knew exactly what it was paying every single month. Whereas variable,
you don't know if it's going to go up. And yes, it hasn't gone up this year.
But when it does go up, it's harsh.
Yeah.
It's harsh.
It is. So if you just want the certainty the budgeting, especially if you have a family. And so like me, I'm single, no dependents, no partner. I don't really have the certainty that I need to make sure that I have a roof over my children's heads, other than my dogs, they're my children. But they're a lot cheaper than normal kids.
Yeah.
So a little bit different. But that's really important, is a lot of people do consider their budgeting, and they're like, we're really tight. That extra $100 a month or $150 a month will go really far for us. So we're willing to sacrifice potentially having a lower interest rate in a year's time for the certainty now.
Yeah.
So
one con to my loan is I couldn't have an offset or a redraw account on it. Is that usually the case with most fixed loans?
Most fixed loans, yes. Generally, you can pay only a certain amount extra to the loan over the fixed period because they don't want you paying it off and taking leverage of the fact that it's a lower rate or a certain rate. And it's the same thing if you wanted to pay off the loan, not the refinancing, but if you sold the house, you also have to pay a break fee.
Yeah.
So it's just releasing the loan at all. So for instance, a lot of banks, like some of the big four, they will have $30,000 over the fixed term that you can put in extra. And that could be 1 year, $30,000. If you did 5 years, it's also $30,000 over the 5 years.
Yeah, mine was quite, I think it was
Sometimes
$5,000 a year or something.
$10,000 a year,
but my loan was small.
a year. There are some banks now these days that are doing partial offsets. So like say 50% of.
Yeah, I didn't realize you could split it.
Actually, I did that.
Yeah.
Now that we're talking about this, it's so funny how you forget things. Like this happened like 2 years ago, but like literally, how I was like, oh, it was fixed at first and then it went variable. No. We had a split loan. Yeah. So half of it was fixed and half of it was variable because we knew because we needed an offset and we knew we were going to have cash. So the cash went straight into the variable and the fixed just obviously didn't have an offset.
Can we define offsets really quickly?
Yes.
I don't think we've done it yet.
Offset.
Yeah, I mean, I wasn't even talking about split loans. I was talking about partial offsets.
Oh, okay.
It's a whole different thing as well.
Yeah. Define offsets and we'll talk about partial
So
and split.
an offset account is, I mean, I touched on it at the start with net of offset. So offset is basically an account that sits separate to your home. It's a home loan. It's an everyday transaction account, kind of like a savings account, essentially. It is a separate account on your statements, on your app, different. It's separated from your home loan. And that is the amount of money that you put in there will offset or deduct the interest that you pay on the home loan. So if you have a $500,000 loan, $100,000 in the offset account, because at any point in time, you could pay that off the home loan. Therefore, the bank's like, well, we don't need to charge you interest on this amount because you have it there sitting there at any point in time. We won't charge you for that. So they will take the loan amount minus whatever is in offset, and that is what you'll get charged interest on at the end of every day.
They don't like this is so rare in the rest of the world. Like it is very Australian.
I didn't know that.
That's not like I was trying to explain to people this in Canada and the US and they're like, what? I'm like,
Well, I guess you usually fix for 30 years. So
Why would you? Do you want to also define what a redraw account is?
So it works the exact same way in terms of an offset account and how I just explained how much is reduced off offset. So same numbers, $500,000 loan. Redraw, however, is not a separate account. An offset account is a separate account, separate line, separate BSB and account number, could have a card attached to it. Redraw is just within the home loan itself. So paying extra into the actual home loan. So $500,000 loan, you've paid in advance $100,000. You could draw that back out. You could take that money back out, aka redraw that $100,000 at any point in time. But technically it's the bank's money at the end of the day. If they decide at some point they don't want to give that back to you, they can. So you have a lot more flexibility with an offset account because it's separated from your home loan.
For a redraw, to access that money, do you have to like go to the bank and say, I want to take it out? Or how does...
Some banks will make you wait a month.
Okay.
Some banks have a minimum redraw amount of maybe $500. But a lot of the times, it's happened with some of my clients, they accidentally put it into the redraw facility and it's locked there for the month because then it needs to go through a month cycle of repayments sometimes. And then you can only take it out. So I had a client that put 20 grand in there accidentally and they needed it for something else. And there was a whole thing with the bank and they needed to go into the bank and sign a lot of documents and then take it back out. So it doesn't give you as much flexibility around it. And that's actually a really good point because when you've got money in redraw on an investment loan, that is not a tax deduction. So money in an offset account, because it's separated from the home loan itself, allows you to have the money separated from the home loan. Therefore, the full loan amount is tax deductible. But if you have the money within the home loan amount, that reduces the amount that's tax deductible.
Why would people get a redraw? It just seems a bit more negative compared
There's
to an
costs
offset.
usually involved with an offset account. So you usually have annual fees.
Yeah. I was
monthly
surprised by
fees.
that. Like how expensive these products can potentially be.
part of a packaged product or an offset product that has one offset account or multiple offset accounts. Also, you need to make sure that the money you have sitting in offset account negates those fees. So, for instance, like NAB or ANZ, they have a monthly fee of $8 or $10 a month. So the way you see how much you save every year by having an offset account is timesing the amount of your savings by your interest rate. So if you have $10,000 in savings, times that by a 6% interest rate, $600 a year you will save by having an offset account.
Yeah, okay.
But if your fee is $395 a year, then you minus $395, you're $205 a year in surplus.
Yeah, okay. So now with the interest rates being so high and fees being quite high as well, you've kind of got to work out how much you need to have in there.
Correct. So if you have usually less than 10 grand, it's not super worth it. So I didn't have an offset account. I just had a basic product because sometimes not having an offset account will be a slightly lower interest rate by 0.05%, sometimes 0.1%, sometimes not at all, but usually you won't have the annual fee.
So a redraw is often cheaper then? Is
Correct.
that okay?
Yes.
And I guess in some cases, some people just want to pay off their house. So having a redraw
They just don't care.
might potentially be beneficial because they're actually putting money away. They're working towards paying off a house as opposed to an offset. The strategy might be the same, or it might be that you want to access that money more.
Also depends what your goal was. At the time when I bought my first home, I still had a lot of surplus cash and I already had my emergency fund saved. I was putting money into shares. So I had my redraw with my emergency funds and then any extra money I put into my share portfolio because that's where I was funneling my money. But if people want more cash, like you said that you have a fair bit of money in savings, you'd like to put that in an offset account. And that also then brings about offset versus savings accounts as well. And what's the benefit there and where's the financial benefit?
Yeah,
Yes.
exactly that. So one of the things that we considered when we purchased our place was we got that split loan. So it was fixed and that we were happy with because it was a low rate. I think it was under 2%, right? And then we had our offset, which was the offset part of the variable of the loan that had the offset, and we put money in there. And strategically, that's where our emergency fund was.
Yeah.
Any other savings that we had, and we would just funnel money in there because for us, I was going on parental leave. So I wasn't working. I'm having that safety net there, eventually selling my first property, putting that money in, which was a really good way to kind of have that balance. And that's why, now thinking about what the next steps are. But
you did touch on a good point. Did you only have one offset account or multiple?
yeah, this is really great. I have multiple offset accounts.
Cool, because you said that that's where my emergency fund sat, the savings, all the different, you just said multiple different things, but was that in the one account or was it all separated into each different account?
Yeah, great question. I think the product that I had, you can have up to like 8 different offset accounts. So I opted for that because I like to categorize some of that stuff and separate it out. I think I saw a stat somewhere that if you have a large amount of money in one account, it's easier to spend it because you see a big number and it's easier.
Yeah,
Have you seen that? You can't also categorize in your head what's for what.
When you take $1,000 out of 50 grand, you're like, yeah, whatever. But if you take $1,000 out of $1,000, you're like, wow, I spent it all. So it's so much easier to spend those little bits.
So now I only have 2 accounts. I have like what I would consider a checking account. So income goes in and that's where expenses go out. And then I have another account, which is emergency fund, savings fund, all the bigger stuff. And so the same amount of money is always coming in. So it's essentially like having a checkings account, but it's my offset. That money's coming in. I'm watching that money go out. And when it gets to a certain amount, if I need to transfer money in because it might be expensive or paying for something additional, like, we had air cons installed and that costs a lot. So we knew that was going to budget in. Then we'll adjust it. But if not, that money is separate. I don't touch it. But it's interesting because everyone thinks about that money differently.
Money psychology is different.
Yeah.
And that's why there's so many different products. A lot of banks, you can only have a maximum of one account.
That would be so hard for me.
Exactly. But then I have some clients that have one account for their savings, salary and everything. So that would be fine. Or they may have maybe maximum 2, one for savings and one for expenses and salary. Whereas a lot of the people that I know that are in our guest circle, we love buckets. And so we like to separate all of our savings in different buckets, just like you do. And so I always have a look at someone's financial system and the way they've set up their accounts. And then I determine from there, is one offset account worth it? Or is multiple worth it? Because then there's different fees involved, different banks. Because if you are like, I'm hard and fast on multiple, then I'm not going to look at half the banks that are going to be one offset because I'm going to show you and you're like, I don't want only one, I want multiple. So there's a lot of factors there that might mean a slightly higher interest rate, but if it means it's going to work better for your financial system, that's usually worth it. So and a lot of people some people have multiple different accounts. So then they have maybe $500 in each account and then one account has 90 grand. One offset account's most likely more worth it for you. Even if you do have all your separate buckets, you leave them the same. The one that has the most of your money, we can make that one an offset account. So it really just depends how much money is in each. What's your financial system? Because I don't want to uproot your entire system that you have that's obviously working for you just to change something in a structure. So it makes sense to just stay with what you're doing, because then a home loan is going to slide right into there a lot easier than me messing around with everything and messing around with your money psychology. So
I've got a question. So I know sometimes if you're on like Facebook groups, like fire Facebook groups, there's a lot of people who fully have like a house paid off. Not fully, but like it's all in their offset. If the bank guarantees up to $250,000 into a bank account, but you have, let's say, $1 million house, you have $1 million offset, is that risky?
not really. I mean, it's your money in an offset account.
But if something were to happen.
Yeah, that's a good point about the $250,000 guarantee on savings accounts. Yeah, because I think that is risky. Interesting.
I don't know the guarantee there because it's not a savings account.
Oh, because it's not a savings
account.
It's
an offset account. I'm sure it'd be the same.
But it's like authorized deposit institutions or whatever.
ADIs.
It does count.
It does count.
I think so, yeah. Just from like a really quick Google, it seems like, because even like the non-bank lenders, it is guaranteed if it's an authorized deposit taking institution or whatever, but it's the $250,000. And surely things aren't going to go too bad in Australia, but like that is a good point.
Yeah. Yeah, very interesting.
I always thought about that. I was like, I should look that up, but it just came up now in conversation.
Actually, yeah. So if you get to that point where you've got over $250,000 in cash, maybe it would be like
multi-offsets.
Offset, and then maybe you'd have a savings account with a different bank.
Does it count multi-offsets? I think it's like one bank, one account holder. Per bank for account holder.
Yeah. There you go.
So if you have a partner, you can have $500K.
Yeah, that makes sense. What if it's a joint account?
It's per account holder, I believe, from memory, from what I looked up.
Yeah.
This, I guess, can slide you into like offset versus savings. I think just a really quick way to explain it is that a savings account, as most people would have, you are earning interest on the savings account. So you will pay tax on the money you earn. Whereas in an offset account, you are saving interest off your home loan. So you don't pay tax on the money you save. So psychologically, people think that they're not financially better ahead because they're not making money. But you're just saving the money. So financially, an offset account tends to be the better financial choice.
Yeah, it depends also what tax bracket you're in. That's something that's really important. I know, I don't know how other offsets look, but like within my bank, you can actually see the savings.
Yes,
so that's always really motivating, nice. Being like, oh my gosh, we saved, X amount. Without doing anything. And that's a completely different mind shift than if you have that deposit that comes into a savings account and you're seeing a certain amount of money coming in.
Sorry, back to our other point. That's a good reason for a redraw actually. Yes. Because then you can put in more and it's paid off your home loan and it's not like a separate offset account with the government guarantee. So if you've got over $250,000, maybe you look at a redraw.
Go into redraw instead.
Yeah, interesting.
Well, this is a conversation. Yeah. Anyways, yes.
Well, that's essential. But an offset account, I think, is really important. That some people think that it will save their repayments. Your repayments don't change. Offset or redraw, it just changes how much interest is added back to your loan every month.
Sorry, the reason I yesed at you is because that was a misconception that I had.
Yeah.
Would you pay it off earlier then if you use an offset? Correct. Would it be like 28 years or something instead of 30?
Usually even paying weekly or fortnightly over monthly because you end up paying 1 month's extra worth of repayments over the year. You pay your loan off 7 years faster on average. Compound.
Fun.
So with your offset, so you might have $1,000 a week repayments. Let's just make it easy. So it'll go down by $1,000, $4,000 over the month. Interest is added daily. So it's calculated daily, but charged monthly. So at the end of that month, then you might have $2,000 added back to your loan. So it'll go back up again. So it's going down and then back up. So it's like 2 steps forward, 1 step back every month. So that 1 step back, however much you have an offset will make that 1 step back a little bit less. So it might, instead of being $2,000, it might be $1,800 it's added back, but you'll keep paying that $1,000 a week, but then only $1,700 gets added back. And so then yes, that's essentially how it works. The repayments don't change, but your repayments will make more dents because the amount added back is less.
Yeah. That was the biggest misconception because when we got our house loan, I was like, if we have more in the offset, it'll only cost us this much. And then realized like, oh, no, like your cash flow is exactly the same. Yeah. And that's the part that's really tight if you are overextending yourself.
Yes.
You know what I mean?
So then you might want a savings account then, because then you can actually get the interest from your savings account as cash. Interesting.
It depends on your cash flow.
Yeah.
Yeah, absolutely.
So many things to consider. Personal finance is personal.
So personal.
Thanks for joining us.
That's okay. That was a fun one.
Yeah, we've got a few more episodes coming up if anyone wants to keep an eye out for those more property ones. But yeah, thank you.
Thank you.
Thanks.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invest or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.